you get the point of that song. Anyway, this is Professor Uriarte again, ready to continue the story about the financial collapse in 2008. And in the first video, we ended the story with the little subplot of Bill Gates buying all the used car dealerships and creating a new asset from that, which he intended to sell. Okay? So that's the idea with CDOs. It occurs when Wall Street firms buy the loans that were originally made to customers like you and me, buys those loans from mortgage brokers and banks, and starts to put them together in a big pool of money so they can issue these new derivative assets and then sell them for fees. They intend them to sell them to institutional buyers, big buyers on Wall Street, like the California State Pension Association or group or whatever it's called, the New Jersey Pension Group. In other words, I'm using examples that you might be able to kind of understand pretty easily. All the states in the union, federal employees, all these all these workers do get as a benefit for their employment a pension. Federal employees get them, California ones, New York State, New Jersey, whatever. And the state put aside money for the pensions for these workers, obviously for their retirement. They have lots and lots of money. They have big pots of money, and they look for secure financial instruments or investments so that the pension funds can grow and they will have enough cash, liquidity to pay retired employees. All right? So in the early 2000s, it did so happen that there was a recession in 2001, and in response to the recession, the Federal Reserve, Ben Bernanke, kept interest rates low. Buyers, like I say, the California State Pension Fund, the New Jersey State Pension Fund, they were looking for other fairly secure instruments to purchase during a period where interest rates on government bonds were very low. If the interest rates on U.S. government securities were 2% in response to the monetary policy of Ben Bernanke, then maybe they could find a 3% or a 4% instrument, financial investment. And they began to. They began to find them with the help of Wall Street brokerage houses like, and financial banking institutions like Bears and Stern, Sears and Lehman, Merrill Lynch, whomever. And these CDOs then became a very popular investment choice or selection by these buyers. Once again, the important thing to see is that the risk is being transferred away from the, well, this is not the original buyer, but they're being transferred away from Wall Street firms to institutional buyers. All right? Now remember, way in the background are persons like you and I, hopefully who will stay employed through many years and pay these loans off. If so, then the interest will go to these pension funds or other big institutional buyers, life insurance companies and the like. If the loans go bad, if there's a lot of defaults, then the risk is borne by those same holders or indirect holders of the assets. And that's what the pension funds and the like are becoming. They're indirect holders of the risk. The risk is being transferred again from the Wall Street firms to the buyers. Now, cognizant of the risk, knowing that, gee, CDOs aren't really quite as safe as a U.S. government security, maybe there's a way we can keep it secure, or maybe we can have something to back it up in case something goes wrong. Because, bad things do happen in the economy. What would happen if that were to be the case? So to protect themselves against default and a fall in the flow of interest income from mortgages, subprime mortgages, and others that were pooled together, they sought out insurance. They sought a means to secure these assets. They went to companies like AIG, which is a notable name from the 2008 episode. And they said to the AIG people, hey, we got these new assets called CDOs. They're based on mortgages being pooled together, subprimes and primes mixed together. The risk is being pooled together, but since it's all very, very, the risk is being spread out, statistically speaking, we find them to be pretty okay. But just in case something goes wrong, just in case these CDOs don't deliver, we want some insurance. Now, AIG had never heard of such a proposal before. There was no such market for anything like this because, after all, CDOs like this never quite existed before. So you're looking at a fledgling market where there's really no regulation, no boundaries about what can happen or what should not happen. Maybe that's a better way to put it. So they began to make deals. They said, okay, we can help you. We'll insure that. I mean, basically, it's almost, you want to pay us like $100 million to insure that these CDOs, which apparently have the blessing of many rating agencies on Wall Street, and they have AAA plus ratings. They're supposed to be very secure. The economists give it their blessing. The Moody's and other rating services give it their blessing. I guess, this is you give us $100 million? Sure. We'll insure these CDOs. Maybe they should insure the CEOs too. There's a little Freudian slip there. But anyway, these new kinds of contracts are called credit default swaps. Credit default swaps. What's being swapped is, all right, money, fees for insurance, for coverage. Coverage against default. If for any reason the CDOs don't deliver, as I say, the insurance contract will kick in, kind of like your car insurance claim kicks in if you should have an accident. So this is a situation where everybody seems happy. There's a new source of income, premiums from credit default swaps for the insurance companies, and coverage, security, minimization of the risk that institutional buyers are taking on in the purchase of these credit collateralized debt obligations. Okay, so everything seems safe and secure. I've explained every step of the way, from the original formation of the mortgage, to the bank, to Wall Street, to the institutional buyer, and now insurance companies, big insurance companies with lots of bucks. What could go wrong? Well, things can go wrong. And here's a crucial step, one of the last crucial steps. Speculators see what's going on, and they see these new credit default swaps being produced. Speculators are people who want to make money in a minute. And they figure out ways to make money on wins and losses. They look at this whole thing and see how the risk is being concentrated in more and more significant ways. The risk is all being pooled and ultimately being held by insurance companies. and they're seeing, well, you know, if there is a recession, if something does go wrong, these people are going to have to get these insurance companies are going to have to pay out and back up and honor the contracts that they're forming with the institutional buyers. So the speculators say, you know what? I want to buy some of those credit default swaps. Speculators like Sally Speculator and Joe Speculator, they want to create for themselves an opportunity to get a big payout when all hell breaks loose. They see the risk being concentrated, even though others who are in the financial industry see it being statistically dispersed. The speculators sort of know the economics better, seeing that the eggs are now all in the basket of the insurance companies, who are willing to pay out, willing to accept payment for coverage. So they say, hey, we want to get covered too. Can we have some of those credit default swaps? And the money pours in. Again, these are newly existent markets, never existed in the history of mankind, humankind. And AIG say, oh, sure, we can just say to our shareholders, see how smart we are? We have new sources of income. Low risk. So these speculators are pretty clever. Right here is like where I like to tell the story. Another one of my analogies. Let's say, okay, I were to approach an insurance company for any of you students out there. And I looked at my students or a group of people, and I said, that looks like a person who's going to have an accident. That looks like a person who's going to have an accident. That person looks like they're going to have an accident. I go up to the insurance company and say, see that person? I want to buy car insurance on them. Now, you can't really do that. But imagine if I could. And then imagine if that person were to have an accident. The insurance company would then have to pay out to the person that owns the car, and then to me, because I placed a bet. I bought a policy that pays out when he gets into an accident. I benefit from that. That's what the speculators are doing. They're creating a way to benefit from a big fallout should it occur in the financial system. And that will double, triple the liquidity demand in a relatively short amount of time for this insurance company. I'm not even sure whether AIG and these other insurance firms that were involved in these credit default swaps really put money in reserve. Remember the reserve ratio the banks work with to create a certain amount of liquidity in case people want to come and withdraw their cash. Insurance companies, of course, do the same, and we spoke about that in class. But with an unregulated market and times just being sort of, well, A-Rob would say loosey-goosey, they weren't very careful creating pools of liquidity and reserves just in case the crap hit the fan. So, what begins to happen? People lose their jobs in California, in Arizona, in Nevada, in Florida, in New Jersey, and in New York. The beginnings of the recession occur. The credit default swaps kick in. That is, the obligations to cover defaults. All right? Because the money's not flowing from the housing, I should say from the borrowers. The money's not flowing in at the same rates from the borrowers, right? Which leaves the institutional buyers who hold the CEOs vulnerable, which kicks in the coverage claim, and now suddenly, in a relatively short amount of time, the AIGs of the world have to pay out coverage. But wait, not just to the insurance company, the institutional buyer, but also to speculators. So the sudden rush to liquidity occurs because this story, this long story that I've told you, is now coming into a sort of negative mode, which is creating the demand for liquidity itself. All right? So in the language of money and banking, all right, in the framework of the T account, I want you to imagine a bank maybe like Chase, which has an account with AIG, all right? And AIG has lots of money in there, relatively speaking, certainly compared to you and me, but suddenly AIG is writing checks galore and huge checks and bigger checks to meet its obligation created by the credit default swaps. And that starts to play havoc with the monetary base at Chase. At Chase, they see this money outflow suddenly, and they need to cover. So what does Chase do? They go to, oh, I know, we'll go to Federal Funds Market. We'll borrow from other banks. They're always ready to help us out. The Citicorp, Wells Fargo, whatever, you know, the big banks that are major players in the U.S. economy. The federal funds market has always been meant and designed to help banks help each other when there are liquidity demands beyond normal expectations. So they make these overnight loans to each other, you know, routinely. But wait, Chase makes a request from, say, Citibank, Citicorp, whatever. And the other bank, I'm just making up names. This is not necessarily meant to be historically exactly accurate. But they make the request for overnight loans in kind of large amounts. And the officers at the other bank say, well, I can't show you. If this were the blackboard, I'd be able to show you. But they look at the whole overview from the housing market to borrowers to banks and mortgage brokers that sold the loans to Wall Street, to firms like Bears and Stern, to institutional buyers like the California State Pension Fund. They see the whole thing, and then they see at the final stage insurance companies paying out huge sums to the institutional buyers and to speculators. And they see the whole big broad view, and they see the money being siphoned off, and they say, no way, Jose. We're not going to lend you. All right? Why? Because they don't trust what's going on. And that's always the story in money and banking. It is ultimately about trust. Trust, confidence, faith, abstract,